Good morning and welcome, everybody. I thank you for being part of our flagship Edelweiss Emerging Ideas Conference. It's my pleasure to be your host today for our first session. 2020 is a year of crazy happenings, but it is also a year of learnings for all of us. And it has opened up new ways to work, think, and live. So today in our first session, we are going to hear insights which will change your perspective forever. And I think for better. It's a sort of a fan moment for me today to introduce Dr. Edward Yardeni, our guest today. Dr. Edward is the president of Yardeni Research, a provider of global investment strategies and asset allocation analysis and recommendations. He previously served as the CIO of Oak Associates, Prudential Equity Group, and Deutsche Bank US Equities Division in the New York City. He was also the chief economist of C.J. Lawrence, Prudential BAB Securities, and E.F. Hutton. He taught at Columbia University's Graduate School of Business and was an economist with the Federal Reserve Bank of New York. He also held positions at Federal Reserve Board of Governors and the U.S. Treasury Department in Washington, D.C. Dr. Ed earned his PhD in economics from Yale University in 1976. Having completed his doctoral dissertation under Nobel laureate James Tobin. Previously, he received a master's degree in international relations from Yale. He completed his undergraduate studies magna cum laude at Cornell University. Dr. Ed is frequently quoted in financial press, including the Wall Street Journal, the Financial Times, the New York Times. Dr. Ed is probably the best market strategist in the world today. He's my idol, and I have been an ardent follower of his work, a sort of silent disciple. I have read his amazing book, Predicting the Markets, a professional autobiography. I think it's a must-read for all market participants. In his book, he shares his unique insights into predicting the markets, the trends, cycles in the domestic and global economies and financial markets, including stocks, bonds, commodities, and currencies, based on the first 40 years of his career on Wall Street. Dr. Yardeni is one of LinkedIn's 2019's top voices in economy and finance. And I'm excited to hear Dr. Yardeni today. And I'm sure all of you are also excited. Welcome, Dr. Ed. And you've been talking about the possibility of roaring 20s. The roaring 20s in the last century was a decade of economic growth, widespread prosperity, largely driven by recovery from World War I. And there was also the Spanish flu and deferred spending, a boom in construction, and it all led to a rapid growth of consumer goods. Do you foresee such times ahead? Take us through your ideas and hypotheses. It's over to you, Dr. Ed, now. Thank you.
Good. Well, thank you so much for that very nice introduction. And thank you very much for this opportunity to join your conference. I have lots of things to talk about, and we'll try to cover quite a bit of ground in thinking about where the US economy and the global economy are right now and where they're going. And I do think that there's a reasonable scenario looking forward over the rest of the decade that once we get through this terrible pandemic, that we may enter what will turn out to be a much more optimistic environment. And I think we could call it the roaring 2020s. But before I go there, let me just review where we are, where we've been recently, and then we can look ahead. I think in many ways, we can think that we've been in a world war against the virus, the coronavirus. And we're still very much in that world war. We're all facing this, this virus collectively. And here in the United States, we're actually facing the third wave of the pandemic. And so far, it looks as though it's worse than the first wave, which we had in February, March, and April. And then things improved somewhat. And then we had another wave in the summer. And now in recent months, we've had this third wave. Now, when we look at the history of wars, it's typical that in wars, there's more than one front. And sure enough, in the current world war against the virus, there are three fronts. The first front is the health front. That's the most important front. We've made some progress there, but we've had some setbacks. Certainly on the health front in the United States, we're seeing the potential here for a vaccine to be made available by the end of the year, early next year, with widespread distribution occurring maybe in the first half of next year. In the UK, this vaccine is already being distributed. And hopefully there'll be enough global capacity in producing this vaccine that we will all be able to put this terrible pandemic behind us, let's say by the middle of next year. But for now, we have some setbacks here where around the world we're seeing renewed waves of the pandemic. But the health front is the most important one. If we don't win that on that front, then the other two fronts aren't going to continue to make progress. Well, what are the other two fronts? There's the financial front. And it certainly looked terrible on the financial front back in February and March. Around the world, here in the United States, we had what to me looked like a mad dash for cash. Not only did we have the pandemic, which was declared on March 11th, but in the weeks before the pandemic was declared by the World Health Organization, we also had a situation where there was a pandemic of fear. And people were going around selling assets. And we saw in the US credit spreads, the spreads between Treasury securities and investment grade and what's often is called junk bond grade bonds. The spreads opened dramatically. Stock market took a huge dive from February 19th to March 23rd. It was down 33%, which by most definitions is the definition of a bear market, over 20% decline. But then on March 23rd, the Federal Reserve responded with what I call QE forever. You may be familiar that in the United States, we had QE1, then we had QE2, then QE3. That was coming out of the great financial crisis, the GFC. Right now, we're in the great virus crisis, the GVC. But coming out of the 2008 great financial crisis, what we saw is that the Federal Reserve, our central bank, came in with 3 programs of quantitative easing, providing a tremendous amount of liquidity, keeping interest rates near zero, particularly in the short end of the so-called yield curve. And it worked. But because the effects of the financial crisis were so great, the Fed, it took several years of these policies to really get the economy going again. And then they started to reverse course and decided that the Fed was no longer, it was no longer necessary for the Fed to provide that sort of liquidity. And that started around 2016, 17, 18. The Fed started moving towards raising interest rates. But then the pandemic hit this year, and that's when they came in with QE4. And that was on March 15th, and it wasn't enough. It was an announcement of doing $700 billion of Treasury and mortgage-backed securities, but the markets were not impressed. But then within a week, we're talking about March 23rd, the Fed came in and announced that without any limits on time or amount, that they would be buying Treasury and mortgage-backed securities for until the crisis was behind us, until the GVC was over. And that was very impressive. In addition, the Federal Reserve announced that they would backstop the corporate bond market, and those credit spreads started to come back down. And the stock market hit its low on March 23rd. I'm happy to say that on March 25th, we recognized all that. In the morning, we wrote a morning briefing in which we said that we thought that March 23rd made the bottom in the stock market. And I'm not convinced that it's a legitimate bear market. I've been counting a bunch of panic attacks in this bull market since the beginning of the bull market in 2009. Why the panic attacks? Well, 2008 was so terrible, and the market was down over 50%. It wasn't very hard to get people very worried that things were going to get bad again. So we had a lot of corrections, a lot of sell-offs. We've been counting them. They're not all official 10% or more declines, which is what a correction is. But there are altogether, I counted 67 of them. And I view what happened in February and March as really a panic attack. And the Federal Reserve came in so quickly that it reversed the problems we were having on the financial front. Not only that, but it turned everything right around, and the stock market went on, not just to make a bottom on March 23rd, but to go on. And as we know, it's been making several new highs over the past few months. The third front is the economic front. And there too, things look terrible. And there was a lot of talk about the depression, about how we were going to see this thing last for years, or at least that it could take years to come back to the level of the economy in 2019. Well, there too, we've made a lot of progress. As it turns out, we in the United States, we had a lockdown recession. It only lasted 2 months. It's amazing, really, when you think about it. There's never been anything like it. But when you lock down, when you tell people that they have to stay home, that they can't go to work, well, a lot of people were very fortunate because the technology existed to allow a lot of people to work from home. But a lot of people were very unfortunate and were not able to do that and were unemployed. But March 23rd, the Fed did QE forever. By the end of that week, the Congress had passed a bill called the CARES Act, which provided a tremendous amount of fiscal stimulus to the economy. So I argue that basically the week of March 23rd to March 27th was modern monetary theory week. That was the week that this theory, this idea that a government that prints its own money can go ahead and deficit finance a lot of spending, a lot of government spending, without worrying about not being able to finance it because it could always print money. And if the central bank wants to help out and buy some of the securities issued in these deficits, that's a good thing according to the theory. I thought it was a crazy theory, but I'm an empiricist. I look at the facts, I look at the data, and so far I have to say the implementation of modern monetary theory has been working. The only hedge clause that is provided by the proponents of modern monetary theory is that if inflation comes back, then they agree that we should stop modern monetary theory. But so far, as we know, in most countries, inflation remains extremely low. But it is something we want to be aware of and watch out for. But now we've got the pandemic and its third wave in the United States showing signs of problems in Europe. And maybe that's going to create some setbacks for our economies until the vaccines are widespread. But once the vaccines are widespread, I do think we're going to be looking at a global economy that could very well be booming. I mean, it's been a very good recovery in the United States so far. It's been a very good recovery in China so far. German industrial production recently came up, and that's also, everything's been kind of a V-shaped recovery, which suggests that when you lock down an economy for a few months and then you start opening it up, you can have this V-shaped recovery. But where do we go from here? Again, with a vaccine against the virus, I think we could have a recovery, and I think we could have a boom between now and, let's say, the middle of next year, until we get widespread vaccination. We could continue to have challenges on the economic front. But looking beyond that, I think we could see that a lot of technologies that exist today may very well get a very, very big boost from the pandemic. A lot of technologies that companies were thinking and slowly incorporating into their business models have gotten a boost. It's kind of like a booster shot from the pandemic. The pandemic has had unexpected positive consequences for some businesses, particularly in technology. In the United States, we've also had a housing boom because a lot of people that have been living in urban areas have decided that maybe they want to have more space. Maybe they want to have bigger homes. And so we have seen this housing boom in the United States. So that's been a positive consequence. But as we were, as we discussed in the introduction, in the 1920s, prior to the 1920s, there was a terrible war. It was called the Great War back then, but because that was followed by another one, we now call it World War I. And World War I killed millions of people, soldiers and civilians. And then it came to an end, and the soldiers had gotten very sick in the trenches. They went back home, and I think the combination of them coming back, being not in good health, populations being short of food, very vulnerable to disease. And we had this terrible global pandemic of the Spanish flu in 1918 and 1919. Terrible. Again, killing millions and millions of people, much worse than what we're experiencing now. Now, in the United States, we celebrate the holiday called Thanksgiving. And we just had our Thanksgiving last week. Now, I'm thinking that if families were sitting around in 1920 having Thanksgiving, there wasn't much to be thankful for. Maybe, I mean, you had to be thankful that World War I was over, the Great War was over. You had to be thankful that by 1920, it looked as though the worst of the pandemic was over, but there was always concerns that it could come back. And then in 1920, in the United States and many industrial countries around the world, we had a recession. Back then they were called depressions. So there was nothing to be thankful for in 1920 when you sat down to dinner. And I think very few people had any idea that the 1920s were going to bring this industrial and technological revolution that would lead to tremendous prosperity. The automobile, electricity, lighting, appliances, plumbing, plumbing, penicillin, tractors, that could be used for construction. So much just came together and created a tremendous period of economic prosperity, a tremendous boom in the stock market, and that boom ended in a crash and then the Great Depression. But it certainly was a great, it was a great economy during the 1920s. Now, there's similarities. We have a pandemic, nowhere near as bad as the Spanish flu, but terrible for those of us going through having to deal with it. There is a recession, or was a recession in some cases. But the difference now when we're sat down to our Thanksgiving in the United States is we know there are technologies that we're all sharing around the world, whether it be, let's look at the vaccines that are coming out. The first two vaccines are produced with a biotech revolution, a genetic revolution in something called mRNA technology that apparently is revolutionary. Not only can it create vaccines in a matter of a few months, but there are a lot of other diseases that it might be able to give us all kinds of medicines for. So we can start with that. That's a huge, huge deal. But we have artificial intelligence, we've got robotics, we've got electric cars, we've got batteries, just a whole quantum computing. All these, I think, are going to proliferate, be used more around the world. And I think it's going to boost productivity. And the world needs productivity because with the exception of India and Africa, fertility rates have dropped below replacement just about everywhere. So there really is developing a shortage of workers around the world. India has an advantage now with still plenty of young workers out there. And so that's a great plus for India. Africa has that plus. But places like China, places like the United States, Europe are running out of workers. And because of the pandemic, because of trade frictions, some countries are going to want to bring their supply chains maybe closer to home. And I think technology and productivity are going to allow us to do that. And by the way, there's a lot of fears that this is all going to lead to inflation once the pandemic is over. But if productivity makes a kind of comeback that I think it might, productivity is very powerful at keeping inflation down and allowing us to share prosperity. In that kind of scenario, the stock market, I think, continues to go up. Stocks are not cheap. I'm on CNBC and other television financial shows very often, and I'm often asked, Ed, if you had cash, if you missed the bull market in stocks, what would you do now? It's a very tough question to answer. I've been bullish since 2009, and my only answer is, if you've been in the market, stay in the market. If you've owned growth stocks that are expensive, stay with them. But diversify, look for stocks that have lower valuation multiples. And in the United States, we have growth and we got value stocks. And value stocks are cheaper, and value stocks will do better as the vaccines are distributed and the economy broadens out, so that financials and energy are the value stocks. Emerging market economies, stock markets have done extremely well because the markets are anticipating a recovery. And we are getting a recovery. And China has been leading the way. They were the first ones to suffer from the virus, and now they're recovering. But the United States, despite our challenges with the pandemic, the economic news has been remarkably good, and commodity prices are telling us that the global economy is continuing to improve. I'm not a big fan of bonds here because the bond yields have come down substantially, and I think they're being held down by the central banks. But if it wasn't for the central banks, I think bond yields outlook next year will be for bond yields to move higher. So I don't see a lot of opportunities there right now, though if you need coupon income, corporate bonds still offer some return that might do the trick for you. With regards to gold and Bitcoin, all I can tell you is I focus on assets that have dividends, assets that have earnings, assets that have coupons. So I focus on stocks and bonds. Now, of course, there's plenty of ways to invest in gold and other precious metals in the stock market. But with regards to gold, I think having some gold in a portfolio makes sense. We're clearly in an environment that we've never seen before, with a tremendous amount of monetary and fiscal stimulus with this pandemic. Gold has done well. It's taking a rest now. But I think gold, silver, having some of that in portfolio is fine. Bitcoin, there's no fundamentals there that I can help you with. And it's really more for technicians to look at charts and try to figure out the psychology of crowds and what the charts are saying. So I'm not, I look at charts like everybody else does, but I'm an amateur. And but when I see a chart that has gone straight up and is basically back to its record high, I get a little bit nervous that I'm not exactly getting a bargain here, discovering something that nobody else has discovered just yet. Well, with that overview, I think I've covered quite a bit, and now I think it might be worthwhile to go through some charts quickly, and then to leave some room for some questions that I might be able to answer for you. So I am now going to share my screen with all of Well, I'm back with some charts to, they say that sometimes a picture or a chart is worth 1,000 words. And I have some charts here that are worth at least 500 words, if not 1,000 words, that I think will help us to see some of the points I've been making. So here is a chart of real GDP, gross domestic product of the United States. And as you can see from this chart, we had a recession back here in 2008, 2009. It was a severe recession. It was a long recession. It was part of this great financial crisis. Well, now look at this situation where the economy peaked at a record high during the fourth quarter of 2019. But we only had really a 2-month recession. It was really only March and April that economic activity was dramatically stopped by the lockdowns that were imposed on Americans. We were told to stay home, not to travel, not to go to work. We could go to the grocery store. Well, you're in the same situation. You know what it's all about. But in our situation, it was March and April. And, fortunately, as I said, the pandemic is not even close to what was suffered in 1918, 1919, but that's not, that's irrelevant for us. So we're living through it. We're experiencing people getting sick, people dying. It's terrible. But not the fact of the matter is, during lockdowns, we're social distancing. We're not going out, and so there is a tendency for that to work. But while we're doing that, we all get cabin fever. We all feel like it's it's hard to stay in the same house, apartment, not go to work, not have a normal life, and be concerned about the virus that's out there. So in the United States, we had this cabin fever, and we did see the economy just take a dive. And because March is the end of the first quarter, we had a 5% drop in real GDP at an annual rate. That's the way the numbers are calculated. And then in the second quarter, we had a 31% drop in real GDP because April is the beginning of the second quarter. But then, amazingly, we've had this V-shaped recovery in real GDP, where real GDP is up 33% at an annual rate during the third quarter. I'll tell you, I'm an optimist at heart. And I thought that when this first hit, I thought there would be the second and third quarter would be down, and then we would start to see an improvement in the fourth quarter. Then I realized that things were falling apart so quickly in the second quarter that we would probably make a bottom in the second quarter. And I said, okay, so now we'll probably see third quarter up 15%. Well, no, 20%. Data just kept being better and better than even I thought. Okay, let's try 25%. Okay, 30%. Well, it turned out to be 33%. And when it turned out to be much better than I thought, I decided that, instead of maybe 10% or more recovery in the fourth quarter, I kind of brought that down a little bit to 5%. Now I'm looking at something, you can see it on the website of the Atlanta Federal Reserve. They have something called GDP Now, where they track what GDP is doing during the current quarter based on the monthly indicators that are coming out. And right now, the fourth quarter is tracking at a gain of 11%. I mean, so talk about a V-shaped recovery, and you can see it here. I may have to raise my number for the fourth quarter the way things are going, but it's V-shaped. But I do expect what, the Nike swoosh on the sneakers, because we were talking about V's and W's and U's. I don't see a W. I don't see a double dip. I see that the economy maybe slows down in the first half of the year because of the third pandemic. But then I think we could have a boom by the summer of next year as all the cabin fever is offset by Americans traveling around the world and everybody else coming to the United States. I mean, we can have a real boom in some of the service areas like travel, like tourism, like sports events, restaurants, hotels, airlines. I think a lot of them are going to be doing extremely well by then. And on top of all that, I think the broad economy will continue to function well. So we could have a real boom, and it could start to feel like the roaring 2020 starting in 2021. Now look at this figure too. This is an interesting chart, I think. Everybody's got their kind of daily and weekly indicators for thinking about, for trying to assess what's happening to the economy. And I like to look at gasoline usage, which we have weekly data on. It's included in petroleum products supplied, which is what you see in the blue line. And on that chart I'm putting on the red line is hospitalizations, people in hospitals. And you can see we had this first wave of people going to hospitals. We had the lockdowns, and petroleum usage took a huge dive along with the economy in March and April. We hit a bottom in April. If you look very carefully here, you can see me at the gasoline station in May for the first time for 2 months. I stayed home and finally went out and got some gasoline and did some driving around, carefully with the masks on. But you can see that the lockdowns worked and hospitalizations came down. And then we had our July 4th Independence holiday and we weren't careful anymore. We had too many parties and we got each other sick again. And so there's the second wave. And then we started to be careful again in the late summer. But then the kids started going to school and people were not being careful again. And then we've got this terrible increase in hospitalizations and deaths are going up. It's not a good situation. And unfortunately, it's particularly hitting the most vulnerable people in our societies, older people and people with other kinds of health issues. But again, the good news is I think we're going to have several vaccines available within the next few months. So the health front, we're making progress. We're having setbacks. On the financial front, we've made tremendous amount of progress. There's modern monetary theory in one chart. You're looking at the Federal Reserve buying of Treasury securities, and you can see that's QE forever over here. And you can see that QE forever has basically financed a great deal of the federal deficit that was caused by the CARES Act, providing lots of support to people. It was amazing. We've never seen anything like it. We came out of the 2008 great financial crisis. We had QE1, QE2, QE3. The Fed bought treasuries. They brought the Fed funds rate to zero. We had some deficits, but we had nothing like what we've seen ever in since March. And so far, it's definitely allowed us to make a lot of progress in this world war against the virus on the financial front. And the Federal Reserve has been buying Treasury securities, and they've been buying a lot in the longer end, in the 1 to 10 years and over 10 years. And what that has done is it's kept the 10-year bond yield below 1%. I think that's what they're trying to do. Is I think unofficially they're trying to keep the Fed funds rate near zero, which is easy for them to do. But they haven't ever really tried to put a specific target on the long-term bond yield. But so far, the story I've been telling seems to be working out. They're holding that, the bond yield has been holding below 1%. If it wasn't for the Fed intervention, I am convinced, and there's other indicators that convince me of that the bond yield would be at 2% right now. For example, some of you may be familiar with the ratio of the price of copper to the price of gold, very highly correlated with the 10-year bond yield. And that says the bond yield should be at 2%. Well, the Fed is not the only central bank that's providing tremendous amount of liquidity. This is the total assets of the Fed, the ECB, and the BOJ, the European Central Bank, the Bank of Japan, are all increasing their balance sheets dramatically. Again, unprecedented situation. So the results on the financial front, great success. We're winning the war on that front because it could have been horrible. It could have been a credit crunch just as bad as what we had in 2008. Look at this spread, the yield spread between high yield corporate bonds, junk bonds is the name, less the 10-year Treasury bond yield. This is what it did back here during the great financial crisis. It could have gone there. For those of you who know what the VIX is, it's a volatility index for the stock market. The VIX was highly correlated with this chart. The VIX went right back to its 2008 high, and this spread could have gone there, creating a tremendous credit crunch and all sorts of troubles for the economy, making things much worse. But the Fed came in so rapidly and backstopped the credit markets so dramatically that the spread came right back down. And instead of a credit crunch, look at this. This is corporate bond issuance by non-financial corporations going to an all-time record high of almost $1.5 trillion. Meanwhile, a lot of liquid assets piled up in the mad dash for cash during February and March. And there's still a lot of cash. And I think once the vaccines are here, once we feel like we're getting back to some semblance of normal, I think you're going to find $1 trillion to $2 trillion in the US going back into the economy and going back into financial markets. So that means we could have a melt up in the stock market, and or we could see a real boom in the economy as this liquidity comes back in to the economy and the financial market. So here's the stock market. Had this bear market that lasted 33 days. It was a 33% bear market, lasted 33 days. It was 20 trading days because there's weekends. And it was 7 days that it was actually down from the top by more than 20%, which is the definition of a bear market. So it wasn't much of a bear market in terms of time. And we bounced right off that low on March 23rd, and we've been making new highs ever since. My target for the end of next year is 4,000, which isn't a particularly bold forecast. But you know what? I've been probably one of the most bullish, or among the most bullish forecasters throughout this bull market. And I think it's, I don't want to get too bullish here, since we've seen this thing run so far, and it's not cheap. Look at the forward PE. This is a measure of the valuation of earnings, and the forward PE is at 22.1. That's a very high valuation multiple. It can be justified by interest rates being so low, but it's not cheap. Earnings, meanwhile, are turning around, and I would like the market to just go sideways, but just because I would like the market to do that doesn't mean anybody's going to listen to me. The market's been going up, and it hasn't taken a rest. It would be healthy for the market to take a rest. It has been healthy for the market to widen out. It had been just a few stocks that were leading the way, but the market has been widening out. And but earnings are going to go up, and I'm looking for this kind of trajectory for earnings. So we should be back to where we were in 2019 by, I think, next year, which is really quite impressive when you consider everything that's happened. I'm going to skip some charts here just to move along, so we have time for a few questions. But figure 14 is just shows the S&P 500, and again, we've been leading the way and being bullish on this market. And now we're looking for 4,000. I think at this point, rather than going to some of these other charts, maybe it might be worthwhile to open it up for a little conversation. Before I do that, let me just point out a couple more charts. One is, and this is in the context of the roaring 2020s. Look at figure 18 here. And what you can see is that the percent of capital spending that is attributable to information technology equipment, software, and research and development, all-time record high, 50% of our capital spending in the US now is in technology. Again, and look what it used to be. So this is the technology revolution, which has been going on for a long time, but I think we're getting sort of another wave of the revolution that could lead to a real rebound in productivity growth. And you can see that this is the history of productivity growth going back to 1952. And it's the 20 quarter or 5-year average at an annual rate in productivity. And we had a big increase here in the 60s, then it dropped in the 80s, 70s, 80s. This was the inflation, the great inflation issue. Energy prices rose too quickly. Then we recovered in the 80s, but the real boom, next productivity boom, was in the late 90s and 2000s, and then it came down, and now I think we're going to have another productivity boom. Again, the market had been very narrowly focused on just a few stocks doing extremely well, and that was the top 5 market cap of the S&P 500. Apple, Microsoft, Amazon, Google, Facebook accounted for something like 27% of the market value of the S&P 500, and that's been going on since 2017. But recently, we've seen that the rest of the market is picking up, and that would be a very, very healthy development. So with that, let's do a little bit of discussion, or at least let me have our hosts pass your questions on to me, and we'll see if we need any charts. But I think at this point, I'm going to turn off the
I think it's very, very insightful. So I'll request all the participants, there is a ask questions button. You can, click there and ask your questions. Meanwhile, we already have a few questions, and I'll probably start with one of the most important ones. You said the week of 23rd March was the week of modern monetary theory. Specifically, Ed, what do you think is the stance of MMT outside of US? Because US dollar is the funding currency. What happens to UK? What happens to EU nations like India who don't have the capability to, get very, very high fiscal deficits? What is your stance outside of US?
Well, you make a very, very good point here, and that is the modern monetary people really say that any country that borrows in its own currency can do so without limit other than inflation, because they can print their own money. So India can borrow the Indian government can borrow as much as the Indian government wants to in its own currency, because it can always pay interest and principal by printing more. The problem with that, for those of us who've studied economics or history, is we're taught in school that you do that and you're definitely going to get inflation. But that really hasn't been the case here. And so inflation hasn't been a limit. The UK can do the same thing. The European countries collectively can do it. I mean, the Germans can't do it all by themselves because they no longer have the Deutschmark. And so, but it's the same concept. The concept is, but the really good point you're making, which the modern monetary theorists really don't discuss much, is maybe the United States has a real advantage, because not only do we borrow in our own currency, and we do that more than other countries do. A lot of emerging economies borrow in dollars. And that's a problem, because when the currency is too strong and when the US has interest rates going up, suddenly the emerging markets that borrowed in dollars are in trouble. And so modern monetary theory doesn't work for them in that situation. But the United States, as you suggest in your question, has another advantage, and that is we are a reserve currency. And I know there's been talk for years that it's time to move on to other currencies. Well, the yen is a reserve currency. The euro is a reserve currency. Maybe China's currency at some point will have that kind of status. But there is an advantage to not only being able to borrow in your own currency and print, but if you're an international reserve currency, that gives you another advantage. It is a very good point, and it does suggest that not everybody is especially in emerging economies that borrow in other currencies. That takes a lot out of the concept that a government can do whatever it wants. Look, there's something that just doesn't feel right about modern monetary theory. I mean, it's like you know, you know, it's like the fountain of youth. I mean, you can just drink it and you're young again, you know. I mean, there's water here, I drink it and, you know, I'm suddenly a lot younger. And the notion that you can just borrow and borrow in your own currency and there is no limit, man, that is, what a wonderful world it is. It's hard to imagine it's possible, but it's happening. And I would say that Japan is a very important country to understand as a possible example of where we're all heading. Japan has kind of had modern monetary theory for a lot longer than anybody else has. They've been building a lot of roads and bridges that nobody really needs and borrowing a lot of money, and the central bank owns what, half of the JGBs, and yet their inflation rate's near zero. So maybe there's something to do with demography here. That's my thinking. My thinking is modern monetary theory may actually make sense in a world where we're looking at what I describe as the only way I can put it is kind of a weird way to put it, is that we are experiencing the voluntary self-extinction of the human race. If most of us are getting older and we're not having babies, if there's more people in senior nursing homes than there are babies in maternity wards, your demographic profile is going to become more and more geriatric. More people died in Japan in 2011 than were born, and their population has been declining ever since. Maybe modern monetary theory makes sense in a world like that. I think, you know, India and Africa could be moving in that direction too, because I think the fertility rate came down because of urbanization. You know, when you live in an agricultural community, kids have an economic value. When you live in an urban setting, kids are expensive, they're a cost. So I think we have to factor in some, you know, you don't really study demography when you study economics in school. And I try to understand these things by looking at the broad picture.
Sure. Let me go back to one key question, the dollar. And
Yeah.
probably, I think it will be the second part of my question. But I think emerging markets are a bit different when we talk about modern monetary theory. Our disposable incomes are much lesser. The commodity prices are extremely volatile. You said MMT works if the inflation is not so high, right? Uh,
Yes.
when we look at something like copper moving from 2.0 to 3.5 and
Right.
many commodity prices touching all-time high, should we be worried about that? Is that something, a sign that we should be worried about? And secondly, do you think specifically in an emerging market, rising commodity prices and inflation is probably a possibility that you will get price controls? Are these
Right.
two red flags?
Well, sure. I mean, if commodity prices are falling, we don't have to worry too much about inflation. Uh, we can also look at in the bond market at the spread between the 10-year treasuries and the so-called TIPS yield, which is inflation protected. And we see that inflationary expectations, according to that spread, has increased from about 0.6 or 60 basis points when everybody was just totally depressed and convinced that this pandemic was going to last for a long time and cause a depression. And that, I think, was back in August. But now it's up to about 150 basis points. So the bond market's back to 1.5% inflation in the United States. But as you know, Japan, as I mentioned, has been doing MMT, and yet their inflation rate's close to zero. The ECB's been doing a lot of monetary easing and fiscal stimulus. Even the Germans, who've been usually very conservative about fiscal spending, have agreed to all sorts of fiscal support for people who need it in this pandemic. And yet their inflation rate is close to zero. So I think commodity prices are more indicative of real economic activity rather than in inflation. I think they're being driven not by speculation, about prices going up, and it's a good way to protect yourself against broad inflation. People aren't buying copper because they think their CPI inflation rates are going to go up, and copper is a good way to protect yourself. Maybe they do that with gold and silver, but gold and silver sometimes tell you all sorts of different messages. Gold is very highly correlated with the inverse of the TIPS yield. And so I'm not quite sure how to interpret that one. But to get to your question, I would say that I'm getting positive signs from commodity prices telling me that the global economy is coming out of this pandemic recession much faster than had been widely anticipated. Maybe China leading the way, but you look at production measures in Germany, look at the United States, things are getting better on an economic standpoint, though the headlines on the pandemic are still terrible. Many of us are learning to live with this pandemic one way or the other, and still managing to do our work. And certainly manufacturing indicators look remarkably good. Now, there is an inverse relationship between commodity prices and the dollar. Is it going to create a technical difficulty if I show you that chart? Can I share the screen with you for a minute?
Yes, please go ahead.
Okay, so I'm going to do that here, and I just happen to have it in my package. On our website we have thousands. Okay, sure. Okay. Good. So here's the chart that I think helps us to answer your question. It shows the Goldman Sachs Commodity Index, which is a very broad index, but 60% of it is energy. So it's very heavily weighted in energy, but it's got everything in there. And on the same chart, I show you the JP Morgan nominal broad effective exchange rate. It's the trade weighted dollar, if you will. And look how they're inversely related. Doesn't work perfectly on a short-term basis, but on a long-term basis, going back to the mid-1990s, it tells an interesting story. It says that when the US is doing better than the rest of the world, the dollar tends to be strong and commodity prices tend to be flat to down. Look at the second half of the 90s when we had this technology boom. And technology doesn't really need much in the way of commodities. And so commodities were flat and the dollar was very strong. Then China joins the World Trade Organization on December 2001. And all of a sudden, the dollar is heading down and commodity prices are going up. And then we have the financial crisis. And China and the United States, I think, came out of that crisis better than a lot of other countries, more diversified economies, and just they seem to have done better. But as you can see, the trends are a little hard to see here, but it looks as though after the initial surge in commodity prices coming out of the great financial crisis, we saw that commodity prices started to slowly decline. Then they dropped sharply 2014-15, and then the trend has been down. If you see a trend there, it's down, not up. And the same thing for the dollar, it's up, not down. But recently, we've seen that commodity prices have picked up, the dollar's come down. There's a lot of people that are very bearish on the dollar. I'm not quite so bearish. I think the US economy is going to do fine going into next year. And I think it's going to do fine on a relative basis, but the rest of the world will do fine as well. And so commodity prices should continue to improve, but I don't think that's going to lead to an inflation problem. Inflation, in my opinion, was an episode of the 1970s. We had two oil shocks back then that went right into wages, particularly in the United States. And now we've got too much competition on a global basis. I call them the 4Ds, deflationary forces. The first one is globalization, which starts with a G. So I got a problem because I'm calling them the 4Ds. Let's call it détente, peace. we have a lot of tension around the world. We have a Cold War maybe between China and the United States, but there's still peace. We still have global competition. We still are trading with one another. China just reported a record trade surplus, exports.
Sure.
So competition globally is still deflationary. Technology starts with a T, but technological disruption is fundamentally deflationary. Demography starts with a D, is fundamentally deflationary with aging populations. And finally, debt. We're used to thinking of debt as being stimulative and inflationary. But when we've used so much debt for so long to stimulate, it starts to lose its impact. And instead, all this debt and easy money creates zombie companies that are allowed to stay in business because they can borrow money cheaply and they create a lot of capacity. So long story short, I'm not in the inflation camp, but I'm being careful. I'm watching it because if it comes back, then I have to change my outlook completely. It won't be the roaring 20s. It'll be rising interest rates, falling valuation multiples.
Yes.
Bonds and stocks would do badly. It would be exactly the opposite of what I'm looking for right now. So I can't ignore it. And I can't just tell you everything's going to be just fine. But I don't think the commodity rebound here is going to lead to higher inflation.
Sure. And let me concoct a few questions. I've got a few, and let me put it in one question. I see that you say that these 4 Ds are probably more deflationary than inflationary. So I, believe that this overall trend is deflationary, and you are not so bearish on the dollar as some of the participants are today. Let me ask you, is the short term, this whole pickup in commodity prices, is it a recipe for some kind of a euphoria in the short term? And let me marry this question by asking you, 22 1 year forward price to earnings, India trading at 26 plus, most countries are trading at, I think 20-year high multiples across the board. Is this commodity reflation short term, A, because the underlying trend is deflationary? And do you think these valuations are sustainable for the, let's say, next 3 years or so?
I wish I knew for sure. That's the honest answer. We're all in a strange new world here. And with regards to valuation, we're all kind of wondering what is the right PE, the right valuation multiple. How much should be what's the most we should be willing to pay for earnings when there's uncertainties about what they're going to be exactly. But if there's no recession next year or the year after that, a 2-year outlook is a bullish outlook if the economy is growing. But what should we be paying for earnings? And the question is, we can't really look back at history because history would tell us that what we're paying now is crazy. We should be paying no more than 15, 16, 18. We shouldn't be paying 22. And if you look at that 22, you'll see that growth stocks are like, the big five are selling at 40. By the way, Tesla is going to be added to the S&P 500 in a few days. And last time I looked at that thing, it had a multiple of 150. So that's going to raise the PE of the S&P 500. We're doing some work on that now. But what should the PE be when the short-term rate is 0 and when the Federal Reserve is trying to keep the bond yield under 1%, and so far it's succeeding? I think the stock market kind of knows that because it's not trading as though another way to look at valuation is to look at dividends relative to the dividend yield, relative to the bond yield. And if today we looked at today's dividends, actually I use 4-quarter trailing, but basically if we look at today's dividend and divide it by a 2% dividend yield, we get exactly where the market is right now. So that's telling me that we're kind of at the right place. 22 kind of makes sense relative to a dividend discount model. And by the way, many years ago, that was the way we used to value everything. It just dividends are cash. It's real money. Earnings, not so much. It's dividends, and then sometimes there are issues of how much of it is real. So I do like to look at dividends. Now, if instead we took today's dividends and divided by 1%, which is where the bond yield is, the S&P 500 would be 6,000. So I'm very happy that the market isn't going crazy here with a melt up going in that direction. But I am concerned about a melt up. And there's that a song by Prince called "Party Like It's 1999." Believe it or not, Prince wrote that song in the early 1980s, thinking that by the end of the millennium, by 1999, we're going to party. So he said, let's party like it's now, like it's 1999, and it turned out we had an amazing party in 1999. But then, like all parties that are too good and too excessive, we had a big hangover in 2000. So the NASDAQ is up about 80% from its low in March.
Yeah.
In 1999, 2000, comparable period, we were up 200%. So we're kind of almost halfway to that kind of party. And I am very concerned that I'm not concerned so much about bear markets. I'm not so much concerned about inflation coming back or interest rates going up. I'm concerned, as you suggest, that too much euphoria. Yeah. And we're doing work on Tesla. Tesla is about to be added with the crazy multiple. And Yahoo was added to the S&P 500 in 1999. And it basically made a top there. So I am concerned, there's these bells that go off that tell you, when these things happen, be careful. People are too optimistic. And one of the reasons I don't want to go much higher than 4,000 in my forecast is there are too many bulls around. Everybody's bullish. Yeah. And here in the United States, I doubt you follow our politics very, very closely, but there is a political event that we're all watching, which is on January 5th. We're going to have an election for 2 senators that could bring the Senate to the Democrats. So then they would have the Senate, the House, and the White House. Yes. And then that would give a tremendous amount of power to do some very socialist, left-wing kind of policies, which the market might not like raising corporate taxes, income taxes, wealth taxes, Green New Deals, and all sorts of other things. And that's something that may cause a correction. And that could be coming on January 5th. I think we've already had our Santa Claus rally in November, thanks to the vaccine news.
So let me insert a question here. We were talking about the party, and we were talking about certain changes in regulation. What do you think the markets will like more? Will they like the stimulus to continue, the Fed to continue to pump liquidity, fiscal policy to be easy, or it would like economic growth to come back, but stimulus to go away, and slowly and steadily, Fed starts to unwind what it has done? What do you think will happen at that point? Because I am also reminded of Bob Farrell's rule, when markets are very thin, the breadth is not so strong, which has been the case, I think. If you marry these two, what do you think should occur?
Well, our politicians are not the best of friends. We have a lot of partisanship in the United States, and I guess around the world that's not an unusual problem. A lot of people just don't get along and have different views, and it's hard to get things done. In the United States, we've generally viewed that as bullish. We call it gridlock, but the constitutional system was set up in a way that was supposed to give, it's called checks and balances. And the market usually likes it when we have checks and balances. And that's why I raised the yellow flag, the orange flag. Watch out if January 5th, if the Democrats wind up having complete control of the government. The stock market might not like it. But between now and the end of the year, between now and Christmas, not too many days left, between now and Christmas, the politicians want to go home for the holiday. And I think it would not look good at all if they go home for the holiday and they don't do something for the people that aren't able to cope during this last third wave of the pandemic, if that's what it is. And a lot of people, if they could just hold on to their business or their job through March and we get the vaccine, the economy then could take care of them. And that's what we really want. So I think there's a lot of political pressure for them to probably put together a package of $500 billion, maybe $1 trillion in support for people who need it. And I think that would be a humanitarian thing to do. It would be the right thing to do, even though the fiscal and monetary consequences, are questionable. So I think it's going to happen. I think the market would rally on that news. But there's so much monetary stimulus in the system. There's so much liquid assets that are still on the sidelines as we looked at together before. And there's still some stimulus left over from the CARES Act that I think the economy is not going to double dip. I don't think we need the fiscal stimulus to avoid a recession. I think the economy is going to continue to grow through the third wave, and we'll be okay. But I think the market is starting to anticipate that once we are past the pandemic, all the stimulus that's been provided, some of it's still going to be there, and the euphoria and the cabin fever, that people want to go out, they want to spend, they want to go to restaurants, they want to go sightseeing, that could really get a worldwide boom. Maybe you want to buy new cars and all that. That's what the market, I think, is anticipating. Could be great for earnings, great for productivity. And that would be a pretty good environment fundamentally for the stock market from an earnings standpoint. It's that valuation that's a problem, is everybody's bullish. And that's where we are.
Yeah.
So I think global investors are looking for value, and they found it very quickly in emerging economies. I think they're looking at financials and energy around the world as a possible area to find some value, and that'll broaden out the market, which is a healthy thing.
Sure. So Ed, last two questions before we wind up. First is, any specific outlook on India? Any comments? How do you see Indian economy progressing and probably the market?
Well, India's got a great demographic profile compared to the rest of the world. As I said, fertility rates have dropped below replacement for the past several years, and they're going to go still lower in all of the world except India and Africa. And young people are create a lot of energy in an economy. They create a lot of demand, and to the extent that having a young workforce is rare in the global economy, that gives India should attract a lot of business to India. And as you know, there has been a Cold War that's gotten hotter between China and the United States. And it's likely to persist with the Biden administration. The Biden administration seems to acknowledge that the Trump administration had legitimate complaints against Chinese trade practices and so on. But the Biden approach is going to be more diplomatic, and it's going to attempt to work with other like-minded countries to have sort of a united front to go to the Chinese and say, look, we all want the same thing. We want prosperity. We want things to go well for all of us. Let's do this together instead of creating tensions. And we'll see if it goes that way, but it should simmer down. But still, I think as a result of the trade wars that we've had as a result of the pandemic, there's going to be a lot of companies that are going to want to diversify their supply chains. If they just had them going to China, I think they're already diversifying them into Vietnam, into Southeast Asia, and India certainly has got to be a big beneficiary of diversifying supply chains around the world, particularly if you want to use young labor, and smart labor, and maybe inexpensive labor. India has that advantage. But on the other hand, technology is becoming so powerful in replacing labor and supplementing labor that cheap labor is no longer what it used to be. It's not the secret to, it's not the magic way to run an economy. Maybe it never really was, but we all have to work smarter with our technology. And India's got a great technological base, highly educated people in technology, and technology is going into everything we do now. So I'd be from an emerging markets portfolio perspective, I think India's offers a great deal. China is doing extremely well now, but China's got a real demographic problem, not only because of the fertility problem of urbanization, but also because of the consequences of the one-child policy. And their population is aging very, very quickly. And I think that's going to create some real problems in terms of domestic demand to keep their economy growing as rapidly as it is. So India's got a lot going for it in terms of lots of smart young people, educated people, and technology, a lot of good things.
Sure. Last question, Ed, and because I'm the moderator, I have I can ask you a personal question here. Any recommendations for us to read books, I think, which probably get us up the curve in terms of knowledge, and any specific reads that we should be eyeing for the next 2-3 years, I think, because they are very crucial now.
Yeah, well, thanks for that question, because my answer is read my books. I've been doing this for over 40 years, and in 2018, I wrote a book on my what I learned,
Yes.
and I started writing it 40 years ago. Because I started learning about Wall Street, about financial markets 40 years ago. And when I sat down to actually write it, it took me about 1.5 years. And I told myself that I will not do any original research. I will not try to, solve all the economic problems. I will simply put down what I have learned based on my experience in the past 40 years. So every chapter focuses on, forecasting the economy, forecasting inflation, interest rates, the Fed. And then what I found is that the book turned out to be a little bit too long for some people. It's about 600 pages long. And the other thing is, I hope my career lasts another 40 years. So I'm still learning. And writing the book helped me actually learn more, to understand things better, because helped me to organize what I had learned. And so what I'm doing now is I'm spinning off a lot of the chapters into individual books. So, one of the chapters was on the Fed, and now I've got this thing called Fed Watching for Fun and Profit. And it's basically my experience watching the Fed. And the way I did it was I became very much a follower of each of the Fed chairs, trying to understand them, get into their thought process, and not be a critic, but to just be sort of a profiler. In the criminal shows, they have profilers who try to figure out, how is the head of the psychopath working? Well, that's maybe not a good example, but I try to get into the head of the Fed chairs, because they really do drive probably the most important policy on the planet Earth, and that's Fed monetary policy. I just did a piece on the S&P 500. All these things are on the Amazon, and they're cheap. I'm not looking to get rich on it. I'm looking to kind of download my brain of what I've learned and share it. And I'd be delighted to get feedback. I get lots of feedback. I post on LinkedIn, and you can read some of my work there. So, you gave me a very generous question here to promote my work. But again, I'm doing it more because I want to share what I've learned and still learning. And so I'm already thinking about another chapter on the Fed. Just this year alone, I could probably write a book on how the Fed has responded to the pandemic. I am working right now on two studies, one on corporate profits and prosperity. How's the idea being that profits drive prosperity, and dealing with some of the controversies there. Also controversial is income and wealth inequality. And so I'm writing a study on that. And I'm very data oriented. I like to start with the data and then come to the conclusions. I find too many of my peers have their theory, have their conclusion, and then find the data that supports it. So I find this to be intellectually fascinating field, and you're constantly being tested by the markets. And so for all of you who are part of this, the same world that I'm in, it's a great deal of fun. It's a great intellectual exercise, and hopefully it will be an area of prosperity for you. But most important, stay healthy.
Thank you, Ed. And I think I've been a follower of your work for a very long time. I've read your book start to end, word by word. And Ed, I think we come to an end to our session today. Thank you very much.
Yeah, I just have to apologize. We had a technical difficulty on my end, which is why we started late. But now I think I got it figured out. So anytime you want to do this again, let me know.
Thank you, Ed. Thanks for that great, insightful session. And probably we'll meet again.
Thank you. Absolutely. Look forward to it.
Thank you.
Bye-bye, everybody.